If you're a retired federal employee, state worker, or public employee who took a withdrawal from their Thrift Savings Plan or TSP, you need to pay attention because you could be walking right past one of the most powerful tax planning windows in decades. Joining me is Joshua Cicora, CPA and lead tax advisor with Market Tax Services. Joshua, what is this opportunity and why is it limited?
It's limited because people need to be aware of it, and there's some timelines involved that really do matter. What a lot of retirees don't know is that Kansas and Missouri don't tax certain government retirement benefits like TSPs. There's really a whole extensive list that there's a lot of nuance in. So if your traditional IRA came from one of these sources, like that TSP account, and you're looking or interested in doing Roth conversions, you can avoid Kansas or Missouri state income taxes altogether.
That makes the Roth conversion cheaper since you're not having to pay for the state taxes, which are normally due on Roth conversions. But for federal employees, retired federal employees, there's oftentimes these extra tax benefits that they're not getting from their current financial advisor.
Yeah, exactly. So starting in 2025, so literally right now, there's a new senior deduction for people 65 or older. That's anyone born in 1960 or earlier. It's a pretty generous deduction, and in many cases, it can eliminate federal taxes on your Social Security benefits.
And so I saw the numbers. The White House estimates 88% of seniors will not pay federal income taxes on their Social Security at all. And that's up from where they're estimating was 64% before all this bill was passed with the One Big Beautiful Bill. And so that opens up even more planning opportunities where sometimes people can do these tax strategies and pay sometimes zero out of pocket.
Yeah, and that's exactly right. And it's pretty exciting, to be honest. In the right situation, we've helped people convert up to $6,000 to a Roth IRA with zero tax, no federal tax, no Kansas tax, but that's only if it's planned out properly.
Which brings up a critical point here. This is not something retirees should try to coordinate on their own. Between the timing, between income thresholds, Social Security interaction, and knowing which retirement accounts qualify, it's just too easy to get it wrong.
Yeah. So if your financial advisor and your tax advisor aren't working together, you're the one who's stuck in the middle. And now you're relating jargon between two professionals, trying to remember terms like magi and provisional income, standard deduction phase outs. It gets overwhelming pretty quick.
Well, that's why we built a coordinated team here. So instead of retirees having to go act on their own as the messenger, we're communicating that directly. And the financial plan gets the tax strategies in line all before the end of the year.
Yeah, and timing really is everything. These Roth conversions have to be done by December 31st, and this expanded senior deduction from the One Big Beautiful Bill is only available through 2028. It gives us a 4-year window, 2025 through 2028, to fully take advantage.
Well, that's why we put together this quick 15-minute video in our Capers Tax Planning webinar. It covers who qualifies and what to watch for, but most importantly, what this looks like in real life. So what pitfalls await you out there? What unhidden tax bomb is waiting out there to go off and could cost you thousands more in taxes? Worse yet, when are you going to figure it out? If you're being honest with yourself, you probably want to know about these things happening to you before they cost you thousands of dollars, right? And you can learn more about your situation by going to retirementhelp.com and booking that 15-minute intro call with us just to see if you could benefit from going through our full-blown process, that Core 4 report. But if you don't want to book online at retirementhelp.com, you can use that phone number, 833-44-CORE4, or that's 833-442-6734.
It's fast, it's clear, and it can help you avoid costly mistakes. And again, the deadline for that Roth conversion is December 31st. So let's make sure you're on track before that window closes.
Well, and you even normally set the deadline earlier than that. You like early to mid-December.
Yeah, I mean, these things take time to move between accounts to make sure everything is planned out right. So you can't wait till the last minute.
Absolutely. So don't wait for tax season. Your opportunity is now, and you don't want to miss out on this window because it's closing.
That's right. And once it's closed, that's it.
So commingling, That's where the dollars are kind of getting lost that they came from these government pensions.
Yeah, yeah. And so this is really a concern for people who are retiring. They're in the process of leaving the government employer and moving into retirement. And if they are looking at taking lump sum distributions, they need to make sure that those funds don't get mixed in with other funds.
So say I worked at Walmart and I had a 401k there, but then I went and worked for the federal government. I don't want to have my Walmart retirement account dollars and my federal or my state or whatever the government retirement plan is. I don't want to mix those dollars because then it loses the tax benefit.
That's right. They can't tell which dollars came from where, which earnings came from which source of dollars. It's too confusing for the government or anybody to figure out. So they just say, too bad, so sad. You lose that tax benefit because you didn't have the right information to do the right things at the right time.
So we've got a couple examples here to use because I don't know about most people out there listening or watching. I'm a visual person. I have to see the numbers. So we've got an example of a single person and we've got an example for a married couple. This first example with Mark, he's retired and has a taxable income of $32,775. But he's got a lot more income than that. It's just not all being taxed.
That's right. Just the way the math works out as you roll through the tax law.
So he's taking $38,000 a year out of his IRA or his retirement accounts, like his old 401k. But then he's receiving or collecting $25,000 in Social Security benefits.
Yeah, and because of the way the tax law works, not all $25,000 is taxable. It depends on what other income he has in play.
So there's a couple of different things going on in this equation, not just the Social Security tax formula, but also the standard deduction, and then this new standard deduction, the senior standard deduction, since he's over the age of 65. Well, he wants to go on vacation with his buds, and so he's wanting to take this $1,000 withdrawal. So he calls up his financial advisor and says, "Hey, I'm going to take this road trip with my buds on this concert. Can you send me $1,000?" "Well, sure, Mark. Do you want us to withhold taxes?" That's my financial advisor voice.
Sounds very helpful.
And so while Mark's on the phone with him, he's thinking, "Well, yeah, I don't like owing taxes. How much should I withhold?" "Well, Mark, we're not your tax advisor. We're your financial advisor." And while I hate that answer, it's the right one because that financial advisor is probably not licensed to give tax advice.
That's right. So while it's not a complete answer, at least it's a responsible answer.
So what do we do when we typically don't know something?
We check with our friend Google.
or even AI, right? But sometimes the internet doesn't know, those search tools don't know what we don't know, what we're not aware of, and what could be running in the background. And that's what's happening to Mark here, because Mark thinks, well, my taxable income is $32,775. I guess I'm filing single. I'm in this 12% tax bracket, but he's not. He's in a 22% tax bracket. How does this happen this way? Well, let's check under the hood, right? You got before the trip and after the trip. You got a comparison here. You want to take us through this?
Yeah. So if we look between the two, well, his IRA income, other than that $1,000, it's pretty much the same. It doesn't change, right? But the taxable Social Security is where it all happens because of the $25,000 he had before. A piece of it was taxable, right? But now he takes that extra $1,000 distribution. He doesn't pick up just another $1,000 of taxable income. He actually picks up another $850 on top of that $1,000. So now he's up to $1,850. But now you're saying, now wait a second, Josh only took $1,000 in cash. But that's because he changed the way these formulas are working. And so now he has to pick up in his taxes another $850 of his Social Security benefits being taxable. $1,000 withdrawal turns into $1,850 of taxable income. When you run that through his 12% bracket and then compare that to the original $1,000 distribution, he's picking up 22.2% taxes on a withdrawal that happened in his 12% bracket.
When do you think he finds this out?
Not today.
Not when he takes the withdrawal.
Not when he takes that withdrawal. He's picking that up. He's finding out about that February, March when he goes meets with his tax preparer. And then he's angry because why didn't anybody tell me about this?
Or even you could go the opposite way. People over withhold because of this new standard deduction and they're giving the government an interest-free loan. Tax planning helps us avoid those surprises when you go file the tax return the next year.
That's right. And people might think, well, okay, that's fine. Then at least I don't owe him my taxes. He may not have needed that $1,000 withdrawal if he had his withholdings attuned appropriately.
Well said, well said. So now let's go look at a married couple with a little higher income, because this is where I think it's going to catch a lot of people off guard because they're not used to how this is set up. So Walter and Jane, they're married. They have a taxable income of $105,600. This is including the 110,000 they've taken out of their retirement accounts to supplement the 40,800 they're collecting combined in Social Security benefits. But I don't know about you. When I'm retired, I want to go do things. I want to go travel and see places and visit places. So maybe Walter and Jane here, they're wanting to take an extra $10,000 out to go visit Europe, maybe go to Spain. So they're looking at, well, $105,000 of income. That puts them in the 22% tax bracket this year for married people.
Yeah. And so when they take out this extra 10, they're saying, they've got you do the financial advisor voice so much better.
Yes, Walter and Jane, do you want us to withhold taxes from your $10,000 withdrawal?
Yeah, sure I do. I just happen to know that I'm in that 22% bracket, so sign me up for that 22%.
But really, they're in a 35% bracket.
Yeah.
35% on a big number, $10,000. That's a big difference in taxes versus 22%.
That's right. And so their problem is different than the problem Mark had. Mark was looking at having more taxable Social Security. Walter and Jane, they've already hit that maximum of 85%. What they're facing is a new problem that I think we're going to see some people run into this year. That senior deduction we've been talking about has a phase out. And as your income as a married couple starts to move over 150,000, you lose $60 of that deduction for every 1,000 you go over that 150. And so if you're not planning out how these different pieces interact together, you're going to see that deduction erode. And that's how that's how Walter and Jane here are going to end up owing a lot more in taxes than they're anticipating.
I don't know about you, but if I thought it was going to cost me 22% and then I found out it cost me 35%, I wouldn't be really thrilled that I didn't have a good idea of that expense before I made that decision to take the money out or do whatever, because maybe they had some other money they could have used in a better way, and it wouldn't have triggered this extra tax, this $3,586 in taxes. I've never met the person that loves paying taxes.
No, nope. Nobody likes Uncle Sam so much they want to give him more money.
So if they had money in a Roth, they had $10,000 in a Roth, this wouldn't happen this way.
That's right. And so now as these things start piling up, what is that going to do to the Medicare premiums? Have they just signed themselves up for a whole year worth of extra Medicare costs, all because they didn't know how these different pieces were playing together?
And you're talking about IRMA, Income Related Monthly Adjustment Amount.
IRMA, that's right.
And not your Aunt Irma.
Not your Aunt Irma.
So this stuff is complicated, but we learn what's going on in people's situations when we do the tax planning, and that's how you and I shine. That's where we really shine on working together with the client there, instead of having the responsibility be on the client's shoulder to go figure all this out.
That's right. We meet people, they've already got a financial advisor. They might already have that tax preparer, but very few of them have these people working together in concert at the same table at the same time, making them aware of these pitfalls before they fall into them.
And here's the bottom line. If you're retired and you're serious about maximizing these tax changes in the bill, you need to schedule a time with us to go through your Core 4 report. That's how we help retirees uncover whether these tax changes could protect more of your retirement nest egg. So go to retirementhelp.com now and schedule your 15-minute intro chat with us. But if you don't want to do that, we have a 1-800 number set up. You can do that by calling 833-44-CORE4, or that's 833-442-6734.